All right, ladies and gentlemen, we are back and ready for action. Our 9 o'clock speaker is here. We have Mr. John Bruckner from the McFarland Group. Let's see if we can't pull up this amazing bio that we put together. So John has been with McFarland Group since 2012, holds a BA from St. Joe's in Philly, and then came back home for his law degree here at Creighton U. With his background, he assists closely held companies with the design and implementation of successful business strategies. John is continually collaborating with business owners and advisors to create continuity and key employee incentives. And if he is not working, which he pretty much always is, he can be found on the golf course or hunting birds all over Nebraska. How do we do, John?
That is fantastic.
That is okay?
Yeah, I pretty much have 2 hobbies, and you nailed them outside of work. So thank you for that. Again, I'm John Bruckner. Our firm, McFarland Group, works with closely held businesses to ultimately realize the American dream. First, I want to thank the Alliance Group, Mike and Carolina Mapes, Taylor, Shed, and your entire team for having us here today. And then I'd like to thank all of you on the call for your time and spending about 45 minutes with me talking about exit planning. And so our firm works with closely held businesses, like I said, to ultimately realize the American dream. Well, how do we do that? We start by growing and protecting that business value. No matter what cycle you are in your business, that's key. And then you didn't do this alone. So how do you retain, recruit that key talent? And then ultimately, how do you realize this value at an exit? And that's what we're here to talk about today. So what is exit planning? To me, it's a conscious effort to continually and efficiently convert ownership into personal financial freedom and peace of mind. Well, what does that really mean? I really break it into really 4 categories for an active owner with a leadership team. Who, how much, and what if something happens between now and our exit date? Those are really the issues that you need to be focusing on to get to a planned exit. So what's the difference between exit and succession? I like to think of this as on the exit side, it's the how and the how much, right? The strategic extraction of wealth, how do we get financial security to make sure we have a funded retirement, develop our successors, and navigate tax issues. On the succession side, it's the who. Who's going to take over this business? Is it an outsider? Is it internal management? How are they going to seek and secure commercial financing? How much? What happens if something happens to that leader or successor along the way? What's our plan for that? How do we maintain cash flow? How do we transition those roles and responsibilities from the founding owner to that next generation? How do we maintain that leadership development? What's the course that we need to go on to allow that cash flow to maintain absent the majority owner when they exit that business? So if you're like most business owners that we work with, building your company has been like climbing a mountain. It's a journey. The higher you get in altitude, the bigger the value. The more team members you need, the more risks you have, the harder it's to get that full value out. So again, it's climbing that mountain, which is your business value, that you've made calculated risks along the way. You've had wins, you've had losses. Well, now we've got to the top of this mountain and we're starting the summit. How do we get out? Go ahead. So it's really about what those next challenges are. We talk about gaps, blind spots, minefields. What's going to happen to our plan? What's the gap? Well, that's the how and how much. How are we going to get out? How much? What do I need? What is my business value today? Do I need to grow that value at all before I get out? And what do I need for my number to be secure in retirement? And then on the buy side, what's the collateral needed necessary to buy that business? How do we build that collateral so that we can secure commercial financing and the exiting owner can walk away without risk of the business and then maintaining those earnings going forward? What are the blind spots? Do we have a funded buy sell agreement? What's the disposition of personal guaranteed debt? Most owners have debt on their balance sheet and it's typically personally guaranteed. When they're out of that business, they don't want to be held to that personal guarantee anymore if there's a bad default. So what's the disposition of that? How do we get rid of that? And then minefields. What interpersonal relationships may exist that would create conflict in this transition? Have we accounted for all our stakeholders now working for a new owner? What could blow this whole plan up? Go ahead. So again, if you're climbing this mountain and you're now at the top and looking for your way to get out, you first have to determine what's your plan. How do you descend this summit? Can I do it by myself? Do I have the right gear? Do I have the right people with me? Do I need oxygen? What do I need to do to get off of this mountain? How do I do it efficiently and get the value out? What's the time frame? When do I want out? That's a multifaceted question. For most business owners, they're very tied to their business. This is their baby. They built this business. What are they going to do next in their retirement? Do they have a plan? Do they want to go spend more time traveling? Do they have other businesses they're interested in? What do they want to do next? If you can't answer that question, you're probably not ready. And then financial security. What's your number? What do I need to extract from this business in order to fill my bucket to be financially secure in retirement? And then what's the method? How are we going to get down? How we sell, the multiple tranches, how is it funded, etc. So, and most active owners that we work with, they really value their team. They realize that they didn't get to this top of this summit alone. But now we have to look at this absent that owner if we're looking at our exit date. So what do we need to do to continue to develop that team to be able to climb that mountain without you? Do we need to recruit guys from the outside, or do they exist now? Or is it some combination of those two? How do we retain them? Are there proper incentives in place that are tied to the profitability of the business that reward that team, that talented team, helping you climb that mountain? How do we determine who that next leader is? There's a qualitative and a quantitative side of that. Qualitative, can they play these roles, responsibilities that the exiting owners play? Quantitative, do we have the proper collateral needed to secure commercial financing from a bank? So again, the exiting owner can walk away with cash. How do we groom that right candidate? Have we introduced him to all our other advisors? Does he know where the keys are to the door? Does he know all the things that are tied up into that business owner that need to be transitioned in order to maintain cash flow going forward and continue to grow the business? Again, what hazards exist along the way? There's crevices, there's avalanches that as we climb this mountain that we need to avoid. Avalanches in the form of flight risk. What happens if our key employees or the people who are successfully defect from the business? Have we tied them to that? Again, personally guaranteed debt, taxes. Have we contemplated all these things as we go through this plan that could stop us from climbing that mountain? So here's a little bit of data on exit planning. There's about a little over 6 million closely held businesses in the United States, and 63% of those are owned by baby boomers. And for most business owners, in my experience, about 80% of their wealth can be tied to that business. So it's a substantial asset for them to fund their financial security. However, 62% of businesses don't have a plan at all. And as many as 80% of them haven't even build their transition team. Now, that's not a fault. It's not a knock on business owners. Most business owners are busy running their business, in the business day to day, and don't necessarily have the time or the focus to go work on the business. And so this is what results in that. But then again, it's their most valuable asset. We've climbed this mountain. We've been working our whole career to build this value. How do we extract that value so that our family is financially secure at the time of the exit? So I'd start with 4 tips. Know your number. That's twofold. What's your number to be financially secure? And then it's the next. What is my business value now? And is there any gap in between there? So as many business owners do as they grow, they're reinvesting most of their earnings back into the business. Maybe they've harvested some over the course of their ownership, but there's probably likely some gap between financial security and that business value. So how do we get that out to fill that gap? Know the terms. Are your terms for your transaction feasible? What does that mean? Is there enough collateral to secure commercial financing, or for the successor, is there enough cash flow to maintain those payment terms going forward? Have we actually tested the feasibility of our payment terms? And that also be relevant to the what if. We're talking about exit planning on a planned exit, but what if? What if without a death, a disability, defection? You have a buy-sell agreement that it has terms that are doable, meaning, what's the valuation methodology? What's the down payment if there's a triggering event and the guy needs to be bought out? And how long are those payment terms? 5 years, 7 years? What's the interest rate? Is there enough cash flow from the business to pay that note off and still maintain the business going forward? Also know that if it's an owner leaving, they're probably playing a significant role that would result in the loss of some of that profit. Know all the resources available. So all the resources inside the business, all the resources outside the business, both for the exiting owner and the successors if you're selling to a management team. We need to know all the collateral that's available in this to make this a feasible transaction. And then what's really key for most business owners, especially if you're selling pre-Medicare, Medicaid age, is continuity of benefits after the sale. So healthcare would be massive. Would cost you quite a bit out of pocket, being that you're running a group plan in your business, and now you're going out to the open market. What about the expenses you're running through the business? That might be an opportunity to create some leverage for your buyers to continue those payments going forward. Your gas, your truck, owner discretionary expenses, what ODE stands for, but that could be an offset to purchase price that might help shorten our gap. So again, what do we do with an exit strategy game plan? We work first to identify those gaps, blind spots, and minefields that exist that would hinder a successful plan. 2, we set a timeline. And that timeline is based on the owner's time frame, when he would want to be out, but also how long would it take to get to that financial security number. Assume some growth rates, and then we have to make sure we measure it, which is the what if. Do we hit those or do we not? We may have to extend the terms longer if we don't, or they can be shortened if we grow fast. And then prepare that successor. So that would be management team, ownership skills development, introducing to the key roles, relationships, transitioning that goodwill that exists inside of the majority owner or the founding owner that's exiting that business. And how do we go about doing that to that key employee, which is time. Time is the magic elixir there. So a gap. What is a gap? Shortage to financial independence for the owner. Well, that's the gap in the business value. How much do I need to get out in order to be secure? Gap in financial security. Gap in training, ownership responsibilities to the management team. A gap in collateral necessary for the successor, and if it's a management buyout, to buy out the business. How do we create and incentivize the key employee to continue to grow that business and then create collateral during that process that can in turn be used to secure a down payment and ultimately a loan for buying the business. Blind spots, again, underfunded buy-sell agreements. What's the orderly disposition of ownership under contingencies? Under the what ifs, death, disability, defection, divorce, bankruptcy. What happens to our ownership interest or if an owner has one of those events happen to them? Defection of key talent, insufficient contingency planning. Have we contemplated those risks and put in the proper mechanisms to retain that talent, fund that agreement, provide for the orderly disposition of ownership? Minefields. This is the big one too, especially you can imagine an owner of a business that has led the team now walking off the mountain safely and transition to the next generation. Well, have we accounted for the stakeholders now working for somebody else that aren't part of the ownership team? Have we made sure that their voice is heard and they're going to stay there and continuing in their role for the business? Is there a potential for a minefield that will blow this whole thing up and potentially have a loss of profitability, which could then result in not being able to finance the deal and in turn an unsuccessful exit? And then taxes. Taxes would be the other major minefield. In unknown environments, if we're 5-7 years out, what's the change in the tax environment that could offset this plan, or we're going to have to make an adjustment? So as I said, time really is the medicinal solution here. The more time we have, the better we can plan. I'd say at a minimum, it's 3 to 7 years if you're looking at selling to your management team. Why? You got to create that track record for your successors. You got to create the collateral And we may have to grow the value in order for you to be financially secure in your exit. So we need time to do all of those things. So the earlier you start thinking about this, probably the better off you are. We want to get that lender involved too. A lender is going to make a loan on a deal like this on two things: collateral, that's a math problem, but it's capacity. It's the confidence from the lender that the successor can maintain cash flow after the exit of the owner. So we really need to earn the confidence of that lender in order to make this deal work out. And that is done with time and really the qualitative side of these transactions, which is how do we successfully transition roles, relationships, responsibilities to that next generation. So how do we receive full value? Well, it's by, again, building up that management team, that leadership team to build this and run this business independent of you, incentivizing them properly to create enough of collateral to secure a down payment. That would be how you secure a bankable exit. Most owners don't know they can even sell to their management team because the first question they ask is, well, how are they going to buy me out? They don't have the money to. Well, we got to help create that, and that's created over time. So what we go through a process that starts with what we call Inventa, which is Latin for discovery. That's a long process where we understand your people, your property, what have you committed to, what's your business valuation, what risks exist, etc., and ultimately calculate your value to start determining where those gaps may exist for what we need to get out in order to be financially secure. Ultimately, that results in an exit strategy game plan that we begin to implement sometime between now and the planned exit date. So this is a little bit more of a graphical depiction of that same process. Again, we really want to understand the people, the potential successors, the stakeholders of the organization. How is the cash flow of this business maintained? What's the valuation? What investments exist? What agreements have we made? What have we already committed ourselves to? Does our buy-sell agreement in alignment with our exit strategy? What financial obligations do we have? Do we have personally guaranteed debt? How do we get rid of that? Do we have a bond? Are we a general contractor? And we have to maintain a bonding capacity in order to do our work. Well, how do we transition that bond to the next generation of leaders? And then that's the gap analysis. Again, blind spots, minefields. What's the capacity of the successor? Is this transaction financially feasible based on the cash flow of the business now? Do we need to create more profitability in order to make this successful? And then we go into teaching. We want to collaborate with all the other advisors. We want to bring in those stakeholders. And we want to ultimately come to a plan that's doable for all sides. And then it goes into a wheel. Again, these things don't happen in a day. It's not a 90-day transaction like it maybe would be in a strategic buy. This is something that's going to take a multitude of years to actually implement and fully transition that business. So again, in this Inventa phase, we assess the people, property that are working for you. How do we navigate that river and truly understand your business, who drives the value, and what commitments have been made? As we get through that phase, really what we're offering and really what you need as an owner in order to successfully exit is clarity. There's so much anxiety and unknown going into an exit plan. You don't necessarily know when, you don't know how much, you don't know who, you don't know what happens in all these changes. So there's a lot of unknown. And what we really seek is clarity to act with confidence. We need you to be able to make decisions so that ultimately you can successfully exit your business and receive. So this may come in more than one sale. Oftentimes it's a building block. We're building to a change of control. So there may be a minority interest transitioned at the beginning that would, again, be building towards that collateral. But again, before we get to any change of control, we want to make sure that this thing is bankable so that the exiting owner doesn't have risk of a carryback note and receiving that ultimately receiving that fair value. And we really want to maximize that effectiveness.
Yeah.
Available to the team.
Just because it's on your account.
It's all right.
I thought about that.
And then it's prioritizing that plan. It's working on that plan and implementing that over the time frame between today and your chosen exit date, anticipating any changes that may happen. So again, your bankable exit is really about these components that you see around this wheel. What goals? What are your goals? When do you want to be out? How much do you want to get? What do you want to do after you exit your business? What roles are you playing now? How do you begin to transition those roles? And one thing I usually start when I'm talking to an owner, I said, what do you like doing most? And what do you like doing least? Keep it pretty simple. Get rid of what you like doing least first, and hold on to what you like doing most longest. That would be how I look at that. What resources are available? Again, what financial resources are available? What legal resources are available? What process do we have to go through in order to make this a successful exit? What's the capacity of our successors? Have we been able to transition those roles and relationships? Do they know everything about the business? Have they put their 10,000 hours in the management chair to really understand all the different things that may happen to that business? And then collateral. Are we building up towards that 20 or 30% down payment that will allow them to secure a commercially financed note from a third-party lender? Stakeholders. Have we accounted for the stakeholders of the business that are going to be here through a transition? Have we properly put mechanisms in place to retain them and incentivize them to continue to grow in their role with the organization? And then the advisors. So, one thing I have found in my experience is, the advisor team isn't always communicating. They're communicating with the owner. So the owner talks to the lawyer and the banker and the financial advisor and the insurance provider and the bonding agent and all the advisors you may have, your CPA, et cetera. And they don't necessarily always talk to each other. So we want to come in and make sure that they're all working for you together. We're all on this team driving towards this exit plan, putting your input from your respective professional designations and expertise, and ultimately bringing that best plan together to that owner. And then again, we want to account for any blind spots that may exist. Where's the risk? Where's the minefields? How does this thing get blown up? We want to anticipate those and do what we can to mitigate them. What financial obligations have we committed ourselves to? What commitments are already out there that may affect this plan? And then again, we want to do a very in-depth analysis of the business cash flow and continue to update that business valuation between now and the exit date. So we're again making sure this is a feasible transaction. We're constantly testing that model so that as things change, we may need to adjust. So again, our firm is really done proact, persist, collaborate, be thorough, and follow through so that ultimately we receive a successful exit for our owners. Now, again, this can all kind of be summarized into 4 items. Who's going to be the buyer? Is it a third party? Do they exist in our team today? How much? How much do I need to get out of the business? What's it valued at currently? How? What's the process of actually transitioning this value to the next generation, receiving that value for the exiting owner? And then the what happens if something happens? How do we continually work to make sure that we can adjust as needed to any changes in legislation, to our industry, any changes that we haven't been able to anticipate as we begin to design the plan.
All righty, sir.
Any questions, comments?
Yeah. No, I have a few. We've got one coming in. All right, from Janella May. In the capacity as a silent investor to avoid any future legal actions, is it practical and a good idea to keep a founder's fee of 10% of future profits?
So this is asking if we would keep a retained interest in the business we invested in as a silent partner, is that right?
Mm-hmm.
Well, I guess from the perspective of legal actions, assuming it's inside a corporation with limited liability, there's the corporate veil there protecting me of that liability from a legal perspective. So, but purchase guaranteed debt, anything that has a risk outside of that could then go into your ownership interest as a 10% owner. But I think if I'm understanding the question, to avoid legal actions, I would really focus on what the management team is doing, and do you have a board seat as a part of that ownership interest? How apprised are you as a silent investor of that business? And then I'd probably understand the risks there in determining whether I'd have that interest. But if you invested in that business as a 10% interest, or maybe you own more of it at one point and you want to retain 10%, I think that could be a great idea to continue to receive cash flow from the business. And I hope I answered that question right. As far as the future legal actions, again, that corporate veil would protect you personally until the assets of that business were stripped out. And if there's anything personally guaranteed, it could come to you proportionally. And assuming you're the one holding the biggest bag and you have a joint and several personal guarantee, then there could be some issues there. But a particular legal action from a lawsuit, I don't know if the risk outweighs the reward there for retaining that ownership interest. If I answered that question, I hope I did, Genoa.
Yeah, that sounds good. John, how much, I guess just kind of honing in on the founder's fee, when you're working with some of these owners, how much are they wanting to retain, right? As they're exiting their business, what percentage are you seeing that they want some of that profit, they want some of that revenue that's coming into the business even after they have exited?
It would depend. So in a family transition, so if we're transitioning our ownership to our family, it's probably always the case that there'd be at least some level of retained interest. Another thing there is if you're transitioning to a family, the most efficient transaction is a gift. It's tax free. And I'm not suggesting to give your business away to your children, but maybe set an earnings threshold where, for instance, let's say my father owned a business, I own 100% of it, and I owned 0, but I was starting to work for it and run it day to day. Well, then I would probably say, hey, once we get to $1 million of earnings that I created without your help, then you're going to trigger the first gift of 20%. It's going to be tied to some merit. But then again, there's right now in the current estate tax environment, we have a large, 11.7 per individual to gift. So we could use some of that and gift that tax free before we trigger the 40%. Now that all is set to be changed probably here in the next year. That would drop to maybe 3.5 or even as low as $1 million, which would change things a lot about a gifting strategy. But things we've done in the past for a family would be, hey, let's gift after the succession, the change of the roles are made, and I'm truly running that business independent of you. Well, then let's set some thresholds and use some of this gifting. If we want it to be a part gift, part sale, to have some skin in the game, you can do that also. But ultimately, a retained interest would potentially be a good thing in that deal. The other thing that comes in, and let's say a management buyout, non-related parties, there probably might be multiple tranches. So you would sell 20% up front and maybe carry that first note because they don't have the collateral to get that up front. So we want to create that. We're going to carry that first piece. We're not at risk because we still have control of the business. And at the time that gets paid off, okay, now we have a change of control. We can secure commercial financing. And maybe that's when we sell the next 50%. So that owner that owed 100 now has 30. And then as you finance that next tranche, then maybe he holds on to that 30, is basically out of the business as far as day-to-day responsibilities, but is harvesting earnings during that time frame until you pay off that other 50, and then you maybe have a call option down the road to buy that final. Another thing that would go right with that's very key. If you own your real estate, probably the best piece of mailbox money you could get in your years after your exit. So what I see most often in a true management buyout, unrelated parties, would be ultimately the full value, the equity in the operating business gets transferred, but the owner holds on to the real estate, and we sign a long-term lease, and he gets money from the business. They need the building to operate in anyway, and we just execute it that way. That's another way to continue to get some income from the business.
Okay.
So it's different. It would depend on what the goals were to ultimately answer the question, but it's usually not all sold at once because there's not enough cash or collateral to do it all at once. It's a crawl out.
Yeah. Okay.
Multiple tranche sale over a number of years.
Absolutely. Now, are there specific say, specific type of businesses, ideal clients that you work with, size of businesses, whether that be revenue or employee count?
You know, industry-wise, it's across the board. We tend to have a concentration in general contractors and their well, I guess pre-side, the engineers and the architects, we work with some GCs, and we work with a lot of their subs, but I work with dental practices, I work with manufacturing businesses, so pretty industry agnostic. Typically, the businesses we're working with are $1 million or $2 million of EBITDA, earnings before interest, taxes, depreciation, amortization, on up. But I'm not tied to that. I really would actually say it this way. I'm more interested in talking to owners that value their leadership team and are open-minded and growth-oriented.
I like that.
So I would pretty much put it there rather than on a number or size for this. But it actually brings up a point, which I didn't talk about as much, which is valuation methodology. You know, on the how much, knowing your number. Question is, how do I know my business value? Well, a lot of businesses, probably the most common way a business is valued is a multiple of earnings, multiple of EBITDA, again, earnings before interest, taxes, depreciation, amortization. And that multiple is driven by your size and your industry. Certain industries maybe have higher multiples than others, and the bigger you are, likely the higher your multiple. Why? Because you are more likely to sustain economic downturns. You don't have as much of a concentration in one group of customers or clients, and so you look more attractive from an investment standpoint, so you get a higher premium. And so that would be one way. There's also some rules of thumb, like if you're a general contractor, you're typically an adjusted book value, which is your assets being adjusted from where they've been depreciated, maybe adding a goodwill factor of some kind, less liabilities. That's the value. Or a dental practice, you know, a lot of times is 60-70% of their revenue is how they value those businesses. So there are some rules of thumb per industry on valuation, but ultimately it comes down to the cash flow of the business. How does that business produce cash?
Yeah, interesting. Okay. Shay, any questions from you?
If somebody wanted to like sell their business, is there a place like besides like to their leadership team, if they're just like, oh, I want to like put this out on the market or something? Like, is there such a thing? Just curious.
Yes, it depends, and that's a great question. We tend to focus more on management buyouts. Why? Well, most business owners have contemplated their sale,
Mm-hmm.
and they maybe know roughly what their value is, but they may have had some calls, they may have not. There's not necessarily always going to be that strategic or private equity buyer there. There may be, if you're in an industry that there's a lot of consolidation going on, or you're taking enough market share from someone bigger than you as a competitor, they want to buy you as strategic acquisition, amortize you, and then buy their market share back, essentially. That might be one. Or private equity, you're growing at a clip, or you're in an industry that's having explosive growth, and they want to buy you and add to their portfolio and harvest your earnings and sell you 7-10 years down the road themselves. If those things don't exist, there may not always be an outside buyer, but you've created a valuable business that has cash flow, and so look to that team to become your buyer. Let's create the buyers.
Yeah.
But what maybe is the issue there is that how they may not have the cash to get me out, and how do I know who? And it's not always just one person. It's oftentimes a team of people that's going to replace a founding owner. So how do we go about doing that? And how do we go about building the collateral necessary for them to be able to buy the business? And typically that's done in something that you would incentivize. Hey, what role do you play for the organization? Okay, your performance criteria for this year is going to be X, Y, and Z. You hit that criteria, the company's going to put into some account, maybe deferred compensation or in a synthetic equity, like a stock appreciation rider or phantom share that's going to eventually be convertible into that equity or be convertible into a down payment for that equity. So we're going to help get you there, but it's going to be tied on the things you're doing while I'm walking down this ladder as the owner. My roles and responsibilities are going down, yours are going up. So I'm willing to incentivize that. You're creating the profitability now. We haven't sold yet, You're just starting the plan, so we're gonna create cash along this way for you to equal a down payment. And get that financing at the time of exit. So it's really all about that time. I really mean that time is the medicinal solution for an exit, especially if you're selling to your management team. Now, the question you asked, absolutely, there are companies every day that sell to third parties, but if it doesn't exist, they don't have that buyer,
Yeah,
and it's based on their time frame. The other thing is control. You don't have much control in a third party transaction of the timing, of the value. They're probably going to tie you up in an employment agreement for a number of years, and you're going to now be working for somebody else, and you spent 20, 30 years working for yourself.
yeah,
It's a different deal. So what you can do if you start planning, you can still get that same fair market value out, but it requires planning. It requires being proactive up front to then build towards that same exit date that you control. You control the time frame. You control the who. You control the how much. So that's the option that I think is the how that maybe is something that maybe not every business owner sees as an option always.
So to me, I think it's when. When does a business owner come to you? Right? I know, right, in the presentation, it's 3 to 7 years, right?
Honestly, I don't think it's too early.
Okay.
They typically come sometime when they're, well, I call it the perma 5. If I ask most business owners and they want it out, assuming they're age appropriate, the baby boomer age, they'd probably say 5 to 10 years. I call it the perma 5 or the perma 10. Because I ask them next year, it'll be 5 years of that. And then they're actually going to get close to that date and they are tired and they're fatigued. And then they're like, I want out. Yeah. Well, those 3 years or 5 years where we said 5 years went by and now I'm actually ready to be out, but I haven't done the planning necessary to sell my management team. So now I'm liquidation value. I mean, unless you have a third party sitting there ready to buy at the time that you're ready, you're good at timing and I need to talk to you more. But if that doesn't exist, then you're taking a haircut. You're taking a discount on your value if you're waiting until the end and then selling it either worst case scenario, liquidation value, we're just selling the assets that are fully depreciated and paying taxes on them, 30 cents on the dollar maybe.
do they get anything for their name though? Like if their name has built up a reputation?
That would be goodwill.
Okay.
When I refer to goodwill, it's the brand. It's that blue sky value, that intangible value that's above and beyond what's just on the cash flow, same as sort of book value of the business. That's goodwill.
Okay.
So yeah, they've created a brand, absolutely. But how do you value that brand?
Yeah.
So goodwill is very much the art side of valuation. How do you put a value on that brand? Well, if it's Nike, yeah, but it just depends. How do you put it? And that's where the multiple comes from. Multiple would be, a goodwill factor as well. If you have a 10x multiple on $1 million of earnings, it's a $10 million company. Well, I'm getting $1 million a year, assuming I can grow it. It's going to take me at least 10 years to pay that off, no interest.
Yeah.
So that's what that's why I always go to the cash flow. You're looking at that, especially in a management buyout, because you're going to use that cash flow to pay either back the owner that's carried the note or more likely what you plan, paying back the bank so that owner enjoyed their cash into their, years after their exit from their business.
Nice.
Perfect. Booch, you got any questions?
Yeah,
In the room?
the gifting tax incentive, how has it sparked maybe business owners to start kicking off the process and get it going? Has it been a big?
Yes, I was on a call yesterday. This gentleman been a client for about 6 years. He started at $18 million valuation. He has blown himself up to $39 million. We had a pretty complex, this guy's goal was twofold. He wanted his kids to own the majority of his business, ultimately his exit, but he wanted the bulk of his net worth to flow to a private foundation. How do you do that? There's a couple of boring tax laws, but a private foundation can't hold stock in a closely held business for more than 5 years without triggering what's called the unrelated business income tax and a couple other penalties. So we had to solve this thing. We got several million of cash flow coming off, but we got this big purchase price, $40 million. How do we get that out? Well, we had put in some mechanisms, insurance and so forth, to get enough of a down payment so his kids could make a down payment and then use the cash flow to finance the rest of it so that all of his money, like he wanted, would go to this private foundation. And his kids would still own the business. Well, when we contemplated that, the business was worth 18 million. It's now worth 40. So that combined with the tax law compelled him to actually use a spousal lifetime access trust, give shares to his wife that he's going to now that she's going to turn around and give to the trust that for the benefit of him and the benefit of his kids. And then we had to play this game because that money's not going to go to the foundation. That's out of his estate, going to his kids' next generation. We had to play this game of what's the magic number that we're going to lose this 11.7 million. We don't know where it's going, but we're going to lose it. So let's use some of it, but you still want all the bulk of your ownership to flow to your private foundation. So we're not going to go the complete opposite and put it all into this extra trust. We're going to find out a nice number that we use so we can maximize that credit now that's going to go away. It truly is a use it or lose it situation. And so we're going to use that then to determine the amount that we'll put in that slab. And then that slab so yes, it literally happened yesterday. So the tax environment is definitely pushing. Actually, the gentleman out in Colorado, the attorney, had said that, that he believes that this year might be the biggest transition of wealth that the country's ever seen because of the changes. I'm sure some guys at your firm are saying the same thing.
Yeah.
So.
Awesome. Perfect. Well, thank you so much, John, for that
Thank you.
awesome presentation. We will take a short break, and when we come back, we will have our roundtable discussion on talent acquisition tips and staffing your business in 2021.
Thank you very much.
Only like 4 minutes.